My indicators show we're in a period like the 1930s. 2008 through 2022, 23 is like 1929 into 42, okay? A major downturn and a deflationary downturn, not an inflationary recession, a long recession like we'd had from 68 to 82. So that's where we're at. We're at this point. We've had that first crash. I do not see a new high in the markets, okay? Now we're in this bounce, and it is, boy, it's just reticent. It knows it's going to give a big signal as soon as it breaks 10,088, and that's just so many, 3, 4, 5% below here where we've been recently, okay?
Harry Dent, renowned economist and founder of the Dent Research Group, has been warning of an impending economic downturn for the past several years. His prediction is based on the analysis of long-term cycles and trends in the U.S. economy, and he believes that we are already neck-deep into a recession. His view is that the U.S. is experiencing a structural economic shift, which will lead to a much slower growth rate, high unemployment, and a long-term deflationary period. It is stated that this downturn could be even more severe than the one experienced during the Great Recession of 2008. While not all economists agree with Dent's views, he has certainly been a loud voice in the economic community, urging people to prepare for a challenging economic environment. Welcome back to our channel. In this video, Harry Dent discusses the unprecedented stimulus and the bursting of the final bubble and why he believes we are heading to a major economic and deflationary downturn. Please watch, like, and share this video. Also, drop your comments and thoughts below, and remember to subscribe to the channel for more related content similar to this. We begin with a short clip of Harry Dent.
So the markets are in a critical position. We have seen, you have to remember, with all this stimulus since 2009, and especially in COVID, they just took the lid off, and 10 trillion combined fiscal and monetary in just a couple of years. I mean, this is just so unprecedented. The market just kept making new highs, even in a time of demographic and fundamental economic weakness, which I have very good indicators to measure. So we've got this final bubble, and it finally burst. And I studied bubble burst, knowing we were in one of the biggest bubbles in history. And the difference is this one was totally artificial. Past bubbles like the Roaring '20s bubble or the one in the late '90s, these were natural bubbles where the economy is so strong, and especially the tech stocks doing so well, and interest rates and inflation falling. It's just an ideal circumstance. That's when investors will go overboard and overvalue things, and that's what we had, late 94 to early 2000. And now we've had the longest such surge because of the stimulus from early 2009 into late 2021. So the NASDAQ peaked in November 22nd, and the S&P actually on January 4th. Of 2022.
Harry Dent discusses the current state of the markets and the impact of stimulus since 2009, particularly in light of the COVID-19 pandemic. He believes that the market has reached a critical point and that the stimulus has led to an unprecedented bubble. Dent notes that past bubbles, such as the Roaring '20s and the late '90s tech bubble, were natural occurrences that happened when the economy was strong and interest rates and inflation were falling. This is a common trend in economic history, where periods of prosperity and growth lead to a sense of optimism and a willingness to invest in speculative assets, which can drive prices up and create a bubble. However, he believes that the current bubble is different. He argues that it is artificial, meaning it was not caused by natural economic forces, but rather by government stimulus and monetary policy. The stimulus measures put in place in response to the financial crisis of 2008 to 2009 were intended to boost economic growth and prevent a recession. However, Dent argues that these measures have created an artificial bubble that has finally burst. Dent also references the NASDAQ and S&P peaking in late 2021 and early 2022 as evidence of this bubble bursting. He points out that this bubble is the longest surge due to stimulus from early 2009 to late 2021. In other words, the artificial bubble created by government stimulus has lasted for over a decade, causing prices of assets to soar but ultimately resulting in a crash. Dent's argument is that the current bubble is not a natural occurrence, but a man-made one, and it has reached its limit and burst. As a result, he suggests that this could lead to a significant economic downturn. Listen to these carefully.
So we finally got the first crash that was big enough to tell me very high chance this bubble's over, okay? And also the fact that the Federal Reserve and central banks around the world, but in this case, particularly the Federal Reserve, was forced by their overreaction to COVID. Look, it's a natural virus that hits. So why should you do massive stimulus to keep economy from slowing from a natural virus? Nobody's going to blame the government for that. Nobody's going to say there's something wrong with the economy, but they did it anyway because they've been stimulating forever. They know how weak the economy is. Otherwise, they would not have had to stimulate increasingly and escalating since early 2009. So here we are, this great bubble. I was looking for a historic that bubbles when they burst. The extremes are first crash is at least 28% historically and as much as 50%. So when we got that 34% first crash in the NASDAQ, I said, okay, we're finally done here. This bubble has peaked. And we actually went bounced up and we made a slight new low in the NASDAQ, and some markets only retested those. So you could count this first crash as bottoming in June or in October. But either way, we've been moving sideways ever since. That is the two-wave bounce. So remember, in a major market move, whether bullish or bearish, the Elliott wave sequence is, in this case, down. First wave down, two-wave bounce against it, third wave, and the third wave is usually the most powerful, down, and then a fourth wave bounce against it, and then a fifth wave to finalize. So we're in that 1-2 wave, and I have continually believed that since mid-August, we have started that third wave, that middle and most powerful wave typically, and we've just seen the first wave of that. So, you have waves within waves, okay? I don't want to get too complicated here. So we really are. The critical thing to be watching, I'm using the NASDAQ as the lead here. It's a little more tech-oriented, a little more sexy, a little more dynamic than the S&P 500. They're both similar, but I'm looking at 10,088 on the NASDAQ. That's what I'm looking for. That was the low, the last low in October. If we make a new low below that, then it confirms we are in this powerful third wave and the market should start going down faster, harder. And that's when, before you know it, we're going to be down, a few months after that, down 50-60%. That is when investors are going to realize, oh my God, this is not a correction. This is a crash. Oh my God, this is not going to be a recession. It could be a depression. That's going to change the psychology of investors. Because again, since early 2009, they took us out of a recession, really a depression that should have gone from late 2007 top, the top that actually was, it should have taken into 2010 to bottom out that. And the stock should have been down 80+% instead of 57%. So they cut that crash in half. They stimulated the way out of it. And the Federal Reserve, they were thinking, oh, just a year of stimulus and we'll get back to normal. No.
Dent continues his say on the potential economic downturn in this short clip. He believes that a large enough crash has occurred to indicate a high chance of the market bubbling over. He attributes this potential crash to the Federal Reserve's overreaction to the COVID-19 pandemic, which he views as a natural event that should not have warranted such drastic economic stimulus measures. He also references the Elliott wave theory, which suggests that market movements can be broken down into a pattern of 5 waves, with the third wave typically being the most powerful and significant. According to Dent, the market has entered the third wave of this pattern since mid-August, and this wave may result in the market decreasing by 50-60%. Listen to these carefully.
My indicators show we're in a period like the 1930s. 2008 through 2022-23 is like 1929 into 42, okay? A major downturn and a deflationary downturn, not an inflationary recession, a long recession like we'd had from 68 to 82. So that's where we're at. We're at this point. We've had that first crash. I do not see a new high in the markets, okay? Now we're in this bounce, and it is, boy, it's just reticent. It knows it's going to give a big signal as soon as it breaks 10,088, and that's just so many, 3, 4, 5% below here where we've been recently, okay? When it breaks that, we should accelerate down, and then this is happening. Now you've been forewarned about this. I gave my strongest all-out sell signal for stocks twice in December, okay, just before the January 4th peak in the S&P 500. But if you still got stuff and you're still wondering, yeah, maybe or not, boy, that break is your last chance. And I say this bounce And we could see this bounce go on, another so many days or weeks even, if it wants to. This bounce is the last chance to sell into because the next wave is going to be very likely strong. Now, here's the only counter thing. I mean, I always have to consider all possibilities now that we've had an economy so manipulated by central banks for the first time in history. They did not do this in the Great Depression, okay? It was minor stimulus compared to this, okay? So anything could happen here. If we get through this year, 2023, and we don't see markets get much worse than they have been recently and stuff, then you know what? The central banks have pulled off a historic coup. They have avoided what I would call a Great Depression. Now, I would still tell you that I would feel very strongly that by doing that, as Japan has done since the 90s, they will compromise the recovery for years and decades to come, because you have to understand, and this is what economists don't get, they see recessions as the enemy. Recessions are part of the process. Booms expand new things and growth and all that, but recessions wring out all the excesses and bad debts and zombie companies and stuff. We have record zombie companies, record debt levels at all levels, government, private, business, consumers, everything. Purifying this stuff out of the economy makes it stronger. What doesn't kill you makes it stronger. This is what the central banks do not understand, and this is, I think this is very ill-fated policy. So if we do get through 2023 and we don't have a crash much worse than we've already seen, okay? Again, 34, they got to 38% on the NASDAQ, okay? I think it was 27% on the S&P. Then I think we're just in for a mediocre recovery for years to come. The next boom, naturally, from demographics, is late 2024 into late 2037, okay? And then there'll be another boom down the road that'll peak more with a really strong rise of India by then in 2065. Those are going to be the two topping periods in the future. Late 2037 and 2065, give or take. That's something for your children to worry about. So, but this is going to prove something very soon. Have the central banks actually cushioned a depression and made it not as bad as it would naturally be? Again, and that may be the long-term detriment of the economy, which I think it will be, but have they at least accomplished that? Or do we have a final crash here that brings us back down to the levels we should have gone down in 2009 to 2010 or so, in the first crash, like 29 to 32? And I think that's what's going to happen. So again, last chance to sell stocks and risk assets of all type, and especially real estate. And I will definitely keep you updated in this critical time.
In the video, Dent elaborates more on his predictions for the stock market and the economy. He stresses that we are currently in a period similar to the 1930s and 2008, and that we will be in a major downturn and deflationary recession through 2022 and 2023, similar to the long recession from 1968 to 1982. Dent believes that the market will not reach new highs and that the current upward trend is a good opportunity for people to sell their investments before a potential downturn. He also mentions that central banks have manipulated the economy for the first time, which may have negative long-term consequences for the recovery. He argues that recessions are a natural part of the economic cycle and that they help to correct imbalances and bad debts in the economy, making it stronger in the long run. However, Dent criticizes central banks for not understanding this concept and for implementing policies that may be harmful to the economy. Top of form. That's all for today. Kindly let us know your thoughts about Dent's prediction in the comment section below. Don't forget to hit the like button and subscribe to our channel. Also, remember to turn on the notification button so you can get to see more related content like this. Thanks for watching. Anticipate our next video update.